Welcome back to Primary Source China Investment. Peng.guo and I are here with show G3. And we thought we'd do something a little bit different this week and talk about what the mainland investors are facing right now. Because we spend a lot of time looking at what the investment landscape looks like from a US perspective or for a foreign perspective. Because it's important to remember that foreigners own less than 5% of the market cap of AShares, and they're restricted from owning any more than 30% of any one security. So the bottom line is, if stock prices are going to go up, it's going to be the Chinese investor pushing them up. So if we look at the entire asset allocation for a Chinese investor right now, real estate, private, wealth management products, cash, fixed income, and finally stocks, we're going to go through those in a little bit of rapid fire. So let's kick it off with what has been the greatest investment for most Chinese in a long time, and that's real estate. Because for a long time, real estate has been the greatest creator of wealth on the mainland. And I can remember doing a pitch book many, many years ago saying the first asset that Chinese investors buy is a piece of real estate. And the second asset that they buy is a second piece of real estate. And that's actually changed a little bit over the last, 18 months. Been flashing signs of some danger in the real estate sector. And then Beijing has given some mixed messages. So a lot of investors are looking at this and saying, well, it may not be just up and to the right anymore, so we have to look somewhere else. What's your thought about real estate from the retail investor perspective, Peng.guo?
Firstly, real estate is a core business for a country, core business for individual. Most of the individual's asset is related to the real estate. I think is the retail still get a different category. So they have some of them cannot afford the new purchase the house or be the first home buyer, and others and probably get the benefit from the country's growth in the past 30 years. But all of them suffered the change of the China economy. The major things that probably everybody knows, the population, the expectations get decreased. So that is cannot provide the driver for the real estate growth. But at the same time, not all the business or industry, upstream, downstream, they correlate with the real estate business. So nobody expect that this one get crushed. I think right now is it's become entire the country or individuals how they digested the inventory of current real estate. Another problem is the real estate business is not just building a couple of houses. It's really like the build the community and the society. That is a big weakness in the China economy right now. And the most developers, they build a finished house, they go, that is not the end of the story. So it's very complicated.
Yeah, so I guess the question I'm asking is, real estate now versus 5 years ago or 10 years ago or 15 years ago, how is it viewed? You know, it used to be, I buy one, if I can buy two, I buy two, if I can buy five, I buy five. Is that still the perspective?
I don't, at least right now, I don't think so. People become conservative. They used to be like the 10 years ago or maybe 20 years ago. Yes, whoever do that, that's the only way to
make money.
To make money. Yeah, exactly. Don't do anything, any investment. They cannot exceed the real estate investment.
So at least right now, that perspective, you know, that perception has changed a little bit, at least now. So we'll see how it manifests itself going forward. But I want to move on to the next asset class, which is, well, it was P2P lending, it was private equity, it was venture funding. This was an asset class that a lot of people pushed money into because the returns were attractive. There was a lot of, you know, quote unquote innovation happening around new companies, new products. And, you know, venture funding hit a record in China just last year, surpassing the previous high of 2018. And although first quarter of 2022 cooled off a little bit, the earliest stage, just sort of angel investment, saw an increase. So the net effect of this is that big, well-capitalized institutions are in this space now, making it very difficult for individual investors, high net worth individuals or ultra high net worth individuals to compete in this asset class. It's also pushed up valuations for pre-IPO or pre-revenue companies. So you're paying a much higher price for a more speculative business plan.
I think lending the money to individual and the small business is a historical problem. Thousands of years, nobody can resolve it. Now I see that even back to the Tang Dynasty, they have some contract that you see to do that. The bottom line is extremely high, and whoever take it, take the loan sharker money, so they cannot afford it, they cannot repay back. There's a lot of the traps and the fraud and the illegal activities related to this area. And by the end, all the P2P is already get crashed. So entire the sector get crashed. So I don't know the reason for that, but it looks like lending money to individuals is much more difficult and complicated than you thought.
Yeah. So then the next thing is, well, I just put it in my savings account, or I put it in a wealth management, this sort of li cai canping. So savings rate, obviously, it lags inflation rate, so that's not attractive, and that's not just a China problem. That's a global problem. A lot of the wealth management products, they've been under scrutiny. It ebbs and flows. But the lockup periods for those products is not great. It doesn't provide liquidity. You have to sort of keep your money in that, and the underlying risks is not always transparent. So I think that overall, that asset class has become less attractive than it used to be.
Exactly. The reason for this asset class is because the bank provided collateral to ensure the money not below to the 100%.
Right.
So that's the only reason people to buy for that. Actually, banks clients, they are more conservative. They don't know the investment. They trust the bank and they give money to them. I also personally, I have experience by the construction bank li cai canping. So I buy the bank product from my professional experience. I don't know what exactly they are doing. They just tell us that risk 1, risk 2, risk 3, different level.
This is terrible.
I just saw that whoever buy it, I just buy it. Yeah, it's get some problem.
You feel like, oh, if there's a problem, I go back to the bank.
That's exactly right.
Terrible. So
yeah.
Next is the fixed income market, and we've talked about the fixed income market a lot. I don't think there's a lot more to add here. It's the second largest fixed income market in the world. There's thousands of products, trust companies, asset managers, securities firms, even private fund managers issue products. There's long, short duration, there's high credit, there's low credit. There's an abundance there's probably too many products maybe, but there is no fundamental change, in my opinion, on the asset class. But the problem with the asset class is it doesn't give the double-digit returns that a lot of investors are expecting. So in order to get your returns or your expected return, you're going to need to do something else. You just can't get it with the fixed income market.
Bond market, I think, is China's goal. They try to build it and expand this market because in the past 30 years, most of people just know the stock. For the individual perspective, most of the time they don't want to do the bond because the return is pretty low. But the institution, they are more interested in that. But most of the time, bond investment is okay. It's not quite attractive, but it's kind of the asset class. Give the options.
It's pretty consistent and the volatility is pretty low for mainland, for renminbi investor.
That's right.
So that leaves us with AShares. And despite the introduction of cross-border plans and international schemes, home country bias remains strong. According to Broadridge, a consultant firm, less than 5% of the equity allocation from mainland investors is invested outside of China, with a preponderance in Hong Kong. So Chinese equity investors own Chinese equities, and retail still dominates the market. They are looking at what's happening in China. They are reading what's happening coming out of Beijing. They're looking at policy. And from all of these different asset classes right now, it's my estimation that the midterm future favors equities because they're looking for a catalyst. You know, nobody wants to be first, but nobody wants to be last. And there does seem to be a number of voices in Beijing calling for an increase in equity allocation. And one of them was the chairman of the CSRC recently, you know, got a group of everybody together and said, hey, listen, we need to buy more equities. And when the home team goes first, generally speaking, the retail follows. And, you know, what's your thoughts about that, Peng.guo?
That's always the case. So in the China security market, they don't want to get sold 20% over the night. They also don't want to get a crash over the night.
Well, you get a limit up problem. You can't go 20% overnight. You can only go 10%.
Oh yeah, that's right. That's why they set the limit for the daily volatility for that.
Exactly.
I think overall, they still need to think about make the security market become the value-driven market, and as well as try to reduce the speculations in this market. So that's hopefully we see the progress. Yeah, but that's still have a long way to go. And another way is, I think AShares market right now is pretty quite efficient. So all the messages, problem, and the corporate governance, we see they get better and better. But hopefully, so whatever investment benefit or loss is the investor that should take more responsibilities.
The final point here is the savings rate of the Chinese is well documented, and savings rates actually through COVID actually increased a bit. So if you're looking at this from a mainland perspective, you know, what am I going to do with my money? Because if I just keep saving it, I'm going to get 1.5%, and that's not going to cover my inflation. So if investors are looking around, these asset classes that we talked about today have become somewhat less attractive. That leaves, you know, equities as the 800-pound gorilla here. I do see that asset class as the one that investors could flock to, given the background of what's happening on the ground right now.
Yeah, I just want to add 2 more points. That's the 2 big asset class. One is like the commodity. So yeah, it's become the largest commodity in the world. So this market is, I think right now, a lot of the stock investor or institutions start to enter into this market. And secondly, they trigger another asset class they call the strategy-based asset class. For example, like the hedging strategy based asset class. So they're looking for such kind of the product. They're looking for the different strategy. Like the most of the time they try to combine the fund of fund portfolio. So each fund or each strategy they trade like the asset class. So that will give that pretty unique risk and return characteristics.
Yeah, you know, a lot of people say they want absolute return when the market's going down, but when the market's going up, they want relative return. So it will be interesting to see when
the bottom line is that whenever market get up, they just flow to that market.
Absolutely.
Actually, yeah, they don't care too much.
Yeah, people are rational, right? People are rational. So,
exactly.
All right, we're going to leave it there for show G3. Thanks for tuning in. Make sure you hit the subscribe, drop us a note, and we'll see you soon. Thank you.
Thank you.